What folks need to focus on isn't the Fed when it comes to long-term mortgage rates. It's the bond market. Most all mortgages are collateral for bonds. And so it's really the bond market that is, as we call it, the heartbeat of mortgage rates. So in this case, what we saw over the last few weeks, the bond yield dropping to, at one point, barely over 4%. And of course, mortgage rates followed suit. But guess what? Once the announcement was made, very quickly and briefly, the stock market went up 500 points yesterday, midday. The bond yield, 10-year bond yield, actually dropped slightly to just under 4%, about 3.99. But then it went back up. Why? Because Fed Chairman Powell then had a news conference where he explained the decision. The issue there, though, was some of his comments gave the market reason to pause, to consider that while this is good news, we're not out of the woods yet. Chairman Powell, for example, indicated that they're still maintaining a somewhat restrictive policy as it relates to Fed funds. They still have a concern about inflation. Inflation, in fact, most recently about 3.1% year over year. He did comment that the labor market has softened and the unemployment rate has come up a little bit, but it is still low. He also forecast that they may have 2 more rate cuts this year, but possibly only 1 next year. So once that information is digested by the markets, well, what happens? The bond yield started to creep back up. By the end of the day yesterday, the 10-year bond yield had gone all the way back up to 4.08%.